Welcome back to the Deep Dive, where we sift through the sources, extract the concentrated insight, and give you the strategic knowledge you need to be thoroughly well-informed.
Hello.
Today, we are taking on a concept that is, I think, foundational to modern personal finance, but is so frequently misunderstood at a really fundamental level. We're talking about the traditional IRA.
This is a heavy lift. It really is, because most people, they rely on a simple definition tax deferral, and that's it.
Right.
But they don't grasp the profound and sometimes pretty counterintuitive tax mechanics involved.
So that's our mission today.
Exactly.
Yeah.
We're deep diving into a comprehensive analysis of the traditional IRA, moving from its historical pedigree right through to the really complex rules for moving and converting assets.
Okay, let's unpack this then. We're not just talking about a savings account. We're talking about a piece of truly landmark legislation.
We are.
The traditional IRA, or TIRA, traces its roots all the way back to 1974 with the passage of the Employee Retirement Income Security Act. ERISA, exactly. And this act was revolutionary. It set the standards for most private industry retirement and health plans. It fundamentally changed how Americans save for the future.
It absolutely did. And the sources point out just how significant this was seen to be, right away. We found this really striking historical claim from an author in 80 Micro magazine.
Oh, wow.
Yeah, way back in 1982, who described the traditional IRA as, and I'm quoting here, the biggest tax break in history.
The biggest tax break in history. That's quite a statement.
It's a huge level of hyperbole, right?
Okay.
But it suggests the massive leverage and opportunity this account presented, and still presents, for individual savers.
So functionally, let's just establish the baseline for anyone who's maybe a little new to this.
Yep.
What is a TIRA in practice?
Okay, so it's an individual retirement arrangement. It's held at a custodian that's usually a bank or a brokerage firm.
Right.
And the beauty of the TIRA is its flexibility. You can invest in, virtually anything. Simple certificates of deposit, stocks, mutual funds, ETFs.
Even certain types of real estate, right?
Yes, in some cases. It's really just an investment wrapper. And its primary benefit is the tax shelter it provides.
So our mission today is to move beyond that simple wrapper description. We are clarifying who can contribute. We're dissecting the true nature of the tax structure.
Which is key.
Because that simple explanation is often really misleading. And we're going to focus on the complex regulatory framework. That means the income thresholds for deductibility and the logistics of conversions. We want you, the listener, to understand the IRA as a strategic tool, not just another acronym.
Exactly. We need to dissect the eligibility criteria that determine whether your contribution is deductible or non-deductible.
A distinction that so many people miss.
They miss it entirely. And we'll wrap up by clarifying the critical procedures for moving these assets around. The difference between a transfer and a rollover, which, if you get it wrong, can create immediate and really severe tax consequences.
Okay, a lot to cover. Let's start with the fundamentals.
Let's do it.
I think the best place to start is with the foundational contrast, because to really understand the TIRA, you have to understand its philosophical opposite, the Roth IRA.
Yes.
The core difference is all about timing. It's just, when does the government get its money?
That's the perfect way to frame it. The TIRA is structured around tax deferral. You contribute pre-tax dollars.
Meaning
the contribution may be tax deductible right now in the year you make it, provided you meet some specific eligibility rules we'll get into.
Okay.
Crucially, the growth and profits inside the account are sheltered. They're not taxed as they accumulate over the years. But, and this is the big but,
here it comes.
When you take qualified withdrawals in retirement, every single dollar you pull out is subject to federal income tax.
So pay me now or pay me later. The TIRA is firmly in the pay me later camp.
Exactly. And the Roth is the complete reverse. Contributions are never tax deductible. You're using money you've already paid tax on.
After-tax dollars.
Right. The growth and profits are also tax sheltered, just like the traditional. But the ultimate reward, the whole point of the Roth, is that qualified withdrawals in retirement are entirely 100% tax-free.
You sacrifice that upfront tax deduction for the guarantee of tax-free income decades down the road. It's a trade-off.
It's a huge trade-off. You're betting on your future tax rate.
Let's touch on the history of the TIRA. You mentioned ERISA in '74. When did they actually become available for people to use?
According to the IRS sources we looked at, traditional IRAs, which were originally called regular IRAs, by the way.
Regular IRAs. Oh.
Yeah. They were first available for tax reporting starting in 1975. But the limits back then were, they were extremely modest compared to today. It really reflects the economic scale of the time.
How modest are we talking? Give me a number.
The original contribution limit in 1975 was capped at $1,500.
$1,500.
Or 15% of your compensation, whichever was less. And compensation meant wages, salaries, tips.
Think about that, a $1,500 ceiling. It really shows the initial intent was just to provide a small but, significant tax shelter for everyday workers, not for massive wealth accumulation.
Not at all. And obviously, that has changed radically over the years due to inflation and a lot of legislative action.
Right. Our sources track how those limits have evolved, and they note that since 2009, those contribution limits have been regularly assessed for potential increases based on inflation.
Which is an essential feature. If they didn't do that, the value of the tax break would just erode over time and become meaningless.
It'd still be $1,500.
It would, yeah. So to illustrate that evolution, we don't need to read every single year's limit, but let's just highlight the trajectory. Back in 2005, the standard limit was $4,000.
Okay, a big jump.
A huge jump. By 2012, it had climbed to $5,000. And in recent years, we've been looking at $6,000 or $6,500 standard limits, depending on the year. But with the really critical addition of the catch-up contribution.
That catch-up contribution is so important. It's defined as the extra amount that people age 50 and above can contribute, basically recognizing they have a shorter time horizon for saving.
Yes.
What's the common catch-up amount we see in our data?
For many, many years, it's been stabilized at an extra $1,000. So, for instance, in that 2019 through 2021 window, the standard limit was $6,000, and the catch-up brought the total for older savers up to $7,000.
So the consistent increase, assessed based on inflation, it ensures that the tax shelter remains a powerful vehicle in real terms, not just nominal dollars.
It's the government's consistent signal that they want you to save more for retirement, even if they maintain control over when exactly they get their tax revenue from it.
All right, now let's get to the core of this, the advantages beyond that simple idea of deferral. So now we get to the core of this deep dive. The common wisdom, as you said, is that the TIRA is good because you defer tax. But we found that the true benefits are way more nuanced than that. Let's start with two really practical protections. First, protection from creditors.
This is a big one, and it's often really underestimated. For a lot of professionals, especially people in high liability fields, doctors, lawyers, small business owners, an IRA offers a legal shield for that retirement wealth.
It's protected from lawsuits.
In many cases, yes. It acts as an isolation barrier for your nest egg, keeping it separate from your other more vulnerable taxable assets.
And the second point, which I find interesting, is constraint. It almost acts as a protection from yourself, doesn't it?
It does. It's the other side of that coin. While it protects your wealth from creditors, the account simultaneously cannot be used as collateral when you're borrowing money.
So I can't go to a bank and say, hey, I've got $500,000 in my IRA, give me a loan against it.
Nope. That constraint is purposeful. It's designed to prevent the savvy, or maybe not so savvy, saver from being tempted to leverage their future retirement funds for current speculation or, short-term debt. It keeps the money dedicated to its intended purpose.
Okay, here's where the analysis moves into high finance territory. You described the TIRA as possessing an inherent value, like an option in finance. I love that description. What exactly is the optionality value? Why does that make the TIRA so uniquely flexible?
The value lies in maintaining control over your tax timeline. By holding assets in a traditional IRA, you always have the option, that's the right, but not the obligation, to convert all or part of that balance to a Roth IRA.
You can always choose to pay the tax.
You can always choose when to pay the tax. This ability to convert is essentially a financial hedge. You're holding a very valuable option contract against future tax rates.
And the reverse is not true. A Roth, once you put money in, can never be converted back into a traditional IRA. So if you start with a TIRA, you've kept your options open for decades.
Exactly right. You, the saver, get to constantly monitor your income, your expected retirement expenses, the legislative environment, what's happening in Washington. And you can choose the precise year over your entire working life, the year when your marginal tax rate is at its absolute lowest, to execute that conversion.
Like a year between jobs or a year you start a business and have low income.
Perfect examples. That strategic flexibility to time your tax hit adds measurable economic value to the TIRA that the Roth simply doesn't have.
Okay, now let's tackle the biggest conceptual challenge in this entire deep dive. This is the one that I think breaks a lot of brains.
It really can.
The tax mechanics. If I were to ask 100 financial consumers why the traditional IRA is beneficial, I bet 99 of them would say something like, because I get to invest the tax money, and that extra principal compounds faster over time.
Classic answer.
Right. But you argued that this claim is often tax neutral. Why is the conventional wisdom on this so incomplete or even contradictory?
It's incomplete because it completely ignores the final step, which is the tax you have to pay when you pull the money out.
Right.
Most people only focus on the benefit of that initial deduction. So let's walk through a concrete, really simple example to illustrate this tax-neutral argument.
Yeah.
Let's assume the most basic scenario possible.
Okay.
Your marginal tax rate when you contribute is the exact same as your marginal tax rate when you withdraw. Let's just call it 25%.
Perfect. 25% in, 25% out.
Okay. In the traditional IRA scenario, you decide you want to save $6,000 of your pre-tax income. Because it's deductible, you put the full $6,000 into the TIRA.
And because you did that, you save $1,500 in tax today? That's the 25% of $6,000?
Correct. So you invest the full $6,000. Let's say it grows 10 times over 30 years. So it becomes $60,000.
A fantastic result. I'd take that.
We'd all take that. Now let's look at the Roth IRA scenario. You decide to save that same $6,000 worth of pre-tax income. But first, you have to pay the tax.
The 25%.
Right. So you pay $1,500 in tax immediately. You are left with $4,500 to contribute to the Roth IRA.
So right out of the gate, the TIRA started with $1,500 more in principal. This is the exact point where people assume the TIRA wins the race.
It's the crucial assumption, and it's flawed. So the TIRA grows its $6,000 principal by 10 times to $60,000. The Roth grows its $4,500 principal by 10 times to $45,000.
Okay.
Now for the final step, withdrawal. Since the Roth is tax-free, that $45,000 is all yours, free and clear.
Great.
With the TRA, that whole $60,000 balance is fully taxable at your retirement rate, which, remember, we assumed is 25%.
So 25% of $60,000 is $15,000 in tax. $60,000 minus $15,000 leaves you with $45,000 net.
Precisely. In this simple tax rate neutral scenario, the final after-tax value is mathematically identical, $45,000 in both cases.
Wow.
The supposed benefit of having that extra $1,500 compounding for 30 years was entirely completely negated by the final tax liability on the back end.
So wait a minute. If the tax deduction isn't the real benefit, why does every single financial advisor, every website prioritize it? Walk us through why that common wisdom is so incomplete.
They prioritize it because it feels like money saved today. It's a tangible benefit on this year's tax return. But mathematically, the core insight is that the tax deduction and the tax paid on the reinvestment of that deduction, they often only affect your top marginal tax bracket. This makes the entire sub-transaction the part funded by the deferred tax net zero.
Okay, so if the deferral itself isn't the guaranteed benefit, then what is the sole universal benefit that everyone always receives from a traditional IRA, no matter what?
The only tax-saving benefit everyone always gets, regardless of their current or future tax bracket, is the permanent tax exclusion on the profits earned on their after-tax savings.
Wait, say that again?
It's the growth on the portion of your contribution that you actually funded with your own money, the part you didn't defer paying tax on. And this is the exact same incredibly powerful benefit you get from a Roth account.
Tax-free growth.
Tax-free growth.
That is a fundamental paradigm shift.
Yeah.
The actual financial magic of any IRA, Roth or traditional, is that the earnings on the investment are never taxed as they grow.
Correct. Now let's go back to that deduction and clarify the source's conceptual model, which I think is brilliant, the government co-owner concept. How should we view that initial tax reduction?
The $1,500 in our example.
Exactly. When you receive that $1,500 deduction, the source material suggests you should view that as the government essentially investing its money alongside yours for you to manage.
Wow, okay.
The government becomes a silent, fractional co-owner of your account.
So the government is funding a portion of the investment principal, basically.
That's it. And the government's share of the account is comprised of two parts. The original funding it provided, the $1,500 deduction, plus all the tax-free profits earned by that share over 30 years.
So when the account hits $60,000,
the government's portion, which is now $15,000, fully funds the eventual withdrawal tax.
So the withdrawal tax is actually just the government taking back its principal plus its share of the growth, based on the tax rate at the time of contribution.
You've got it. That is the deepest conceptual insight here. The withdrawal tax is conceptually an allocation of principal between owners. It's not a new tax on your gains. No profits, neither yours nor the government's, are ever truly taxed inside that shelter. The only thing that's ultimately taxed is the original principal that was deferred.
And this brings us to the ultimate conclusion. There is no true benefit from deferral unless your tax rate in retirement is lower than your tax rate was when you made the contribution.
That potential difference between the two tax rates is the sole source of the possible financial benefit, or the cost if your retirement rate ends up being higher.
So if you contribute at a 30% marginal rate and retire in a 15% rate, you win big.
You win big.
But if tax rates climb and you retire at a 40% rate, you lose. The TIRA forces you to make a bet on your future tax bracket.
It is a bet. Long-term bet.
We've seen the extraordinary flexibility and the theoretical power the TIRA offers through that conversion option tax optimization. But that flexibility comes with a very heavy chain.
It does.
The ironclad rules of withdrawal and penalty. So let's flip to the downside, starting with the immediate consequence of that deferral, the final tax hit.
It's the inevitable reckoning, right? All qualified withdrawals from a traditional IRA are included in your gross income. They are subject to federal income tax at your ordinary income rate, not the lower capital gains rate.
So it's just like getting a paycheck.
It's exactly like getting a paycheck. It's replacing the employment income tax that was deferred all those years ago.
And if you happen to have any non-deductible contributions, which we're going to discuss shortly, you have to use a really complex formula. It's IRS Form 8606 to calculate which portion of the withdrawal is the tax-free return of your original basis.
It gets complicated fast. But for simplicity, we can assume for most people the vast majority of it is taxable income.
Right. And this creates issue number 2, liquidity.
Yes. Because you face this immediate obligation to pay taxes and potentially penalties, before that cash is truly usable, the TIRA is just inherently a poor choice for an emergency savings fund.
Compared to, say, a standard taxable brokerage account where you'd only pay capital gains tax on the profit.
Exactly.
The third disadvantage is a psychological trap, and it's tied directly to that government co-owner idea we just talked about, the net wealth miscalculation. People see a large account balance and they just assume it's all theirs.
This is a silent danger that can absolutely wreck retirement projections. The actual size of the TIRA balance can be highly, highly misleading. That initial tax deduction was a loan, remember?
And the government's share has grown alongside yours.
Yes. And you must repay that loan upon withdrawal. It's not optional.
So if a listener manages to save, let's say, $1 million in a TIRA, that is not the same thing as $1 million saved in a Roth IRA.
Oh, not even close. It's a completely different number in terms of spending power. If you are in a combined federal and state tax environment that equals, say, 30%,
right,
that $1 million in your TIRA is realistically worth only about $700,000.
A $300,000 difference.
It's huge. When you're calculating your true net wealth, especially for retirement planning, you must subtract an estimate of that eventual tax obligation. Failure to account for that liability leads to overestimating your future spending power by potentially hundreds of thousands of dollars.
Okay, moving into the more punitive realm, let's discuss the penalty box, early withdrawal. The IRS wants this money locked up until retirement, and the stick they use is pretty substantial.
The standard is age 59 and a half. If a participant attempts to withdraw funds before reaching that age, the IRS assesses a harsh 10% early withdrawal penalty.
And that's on top of the regular income tax.
Yes, that is critical. It's applied on top of the fact that the entire amount is included as taxable income in that year.
So let's do the math on that. If I'm in the 25% tax bracket and I need to withdraw $10,000 prematurely, I pay $2,500 in income tax plus a $1,000 penalty. That's a 35% immediate loss right off the top.
Correct. It's a massive disincentive. However, the IRS does recognize certain unavoidable life events that can justify access without that 10% penalty.
Oh.
But remember, the money is still taxable unless it was from a non-deductible basis.
So let's run through the primary waivers. What lets you get the money out penalty-free?
The penalty is waived for death or total and permanent disability of the participant. It is also waived for substantial unreimbursed medical expenses that exceed a certain percentage of your adjusted gross income.
Okay.
And for payments related to health insurance if you're unemployed.
What about planning for life's big expenses like, sending a kid to college or buying a house?
There are waivers that cover higher education expenses for you or your dependents, and there's a specific waiver for a first-time home purchase, although that is limited. It's a lifetime cap of $10,000.
Only 10,000.
That's it. Additionally, you can set up something called a series of substantially equal periodic payments, which is a very complex annuity structure, and that can waive the penalty, as can payments of IRS levies.
So, a limited safety net, but it's there. Now let's talk about the major constraint that is entirely absent from the Roth IRA. Required minimum distributions, or RMDs.
RMDs.
This is the government forcing the repayment of that tax loan we've been talking about.
It is. RMDs are mandatory. The funds must start coming out and therefore become taxable by April 1st of the calendar year after the participant reaches age 72. It's based on an IRS life expectancy formula. The government has waited decades for its share, and at age 72, it demands it back.
This is a tremendous constraint. If you are someone who saved very efficiently and you don't actually need the money yet, you are still forced to withdraw it. You're forced to recognize the taxable income.
That's right.
And what happens if you forget, or if you just refuse to take the required amount? Let's detail the severity of this penalty because it's shocking.
This is arguably the single most draconian penalty in the entire U.S. tax code, and it must be understood very, very clearly. If an investor fails to take the required amount by the deadline, half, 50% of the mandatory distribution amount will be confiscated automatically by the IRS.
50%. Let's just isolate that for a moment. If your required minimum distribution for the year was calculated to be $20,000 and you missed the deadline, the IRS immediately takes $10,000 as a penalty.
Gone. It's absolutely brutal. It creates a tremendous incentive for compliance, and it necessitates highly accurate accounting as you approach age 72.
And beyond the penalty, R&Ds create taxable income whether you need it or not, which can push you into a higher income tax bracket.
And impact other financial variables, like how your Social Security is taxed.
Which leads directly to the final disadvantage we have to consider, the impact on other government benefits.
Yes, because the TIRA structure forces the recognition of significant taxable income during your retirement years instead of during your working years. This can have a cascading negative effect.
For instance,
high taxable income in retirement may increase the cost of your Medicare Part B premiums. Or it could increase the percentage of your Social Security benefits that become subject to federal income tax.
So a decision you made at age 30 to defer tax via the TIRA can lead to unexpected and higher expenses on things like healthcare premiums when you're 75. It's a very interconnected web.
It really is. Everything is linked.
We've established that the primary benefit of the TIRA is that potential rate differential, but to get that initial tax break, you have to qualify for the deduction. Let's start with the baseline requirement to contribute at all.
Okay, so the absolute baseline is that a taxpayer must have qualified earned income.
Meaning compensation from work.
Right. Wages, salaries, tips, self-employment income. What's generally not qualified is investment income, like capital gains or dividends.
And your contribution is always constrained.
It is. Your contribution limit is always the lesser of the IRS annual limit for that year or your actual earned income.
So if I only earned, say, $1,000 in compensation this year from a part-time job, I can only contribute $1,000 to an IRA, even if the legal limit is $6,500.
Correct. Now, here's the critical distinction that confuses so many people.
Okay.
All U.S. taxpayers with earned income can contribute to a TIRA and defer the taxation on the earnings. That benefit is universal.
But the upfront benefit, that juicy deduction we talked about, that is highly conditional.
Exactly. Deductibility is restricted only if two conditions apply at the same time. First, you or your spouse, if you're filing jointly, participate in an employer-sponsored retirement plan like a 401k.
And
Second, your modified adjusted gross income, or MAGI, is above a specific and, frankly, relatively low threshold.
So let me get this straight. If I work for a company that offers no retirement plan at all and my spouse also has no workplace plan, I don't have to worry about these MGI thresholds.
That is a crucial planning point. You are correct.
I get the full deduction regardless of how high my income is, as long as I have earned income.
Yes. For those people not covered by a workplace plan, the TIRA is often a huge, unambiguous tax win. But for the millions of people who are covered, the MAGI table becomes the arbiter of deductibility. And that leads to either a deductible or a non-deductible TIRA contribution.
All right, let's dive deep into these MAGI thresholds because The actual numbers are critical for our listener to understand. Our sources provide historical data, and they show that these ranges define a phase-out bracket.
Right. The bracket is defined by two numbers. The lower number is the NGI point where you can still deduct the full maximum contribution. The upper number is the phase-out limit, where the deduction drops to zero.
And if your income is between those 2 points,
your deduction is proportionally reduced. We're using illustrative figures from recent years to show the strategic reality of this.
Okay, let's start with the single filing status. For a single person covered by a workplace plan, what's the strategic implication of these limits?
The critical takeaway for single filers is just how small the window is. Look at 2021, for example. The full phase-out occurred between $66,000 and $76,000 of MAGI.
That's only a $10,000 window.
It's tiny. So if you were making, say, $72,000 and you had a 401k, you were only getting a partial deduction. Which brings us right back to questioning the value of that deferral. Is it even worth it?
The ceiling is relatively low. Now, let's compare that to married filing jointly. The window is much wider there, which seems to reflect a desire to support dual incomes.
It is. For a couple married filing jointly, where at least one person is covered by a workplace plan, the phase-out window in 2021 was between $105,000 and $125,000.
A $20,000 window.
Not only is the ceiling higher, but the window itself is twice as wide, giving joint filers a lot more flexibility before that deduction disappears entirely.
Okay, now, let's discuss this tremendous spousal coverage nuance. This is for a married filing jointly taxpayer who is not covered by a workplace plan, but whose spouse is covered. The MGI limits here, they leap dramatically. This is a huge opportunity.
It's huge. The law recognizes that the non-covered spouse needs a tax-advantaged vehicle. So for that non-covered spouse, the MGI range in 2021 went from $198,000 all the way up to $208,000.
That's almost twice the income limit of the general married filing jointly category.
It is.
So in 2021, if one spouse was covered by a 401k, but the other was, say, self-employed without a plan, that self-employed spouse could still make a fully deductible TIRA contribution, even if the household income was approaching $200,000.
That is a massive legislative window. It's a vital tax planning point that any good advisor should be highlighting.
However, the picture is completely the opposite for those married filing separately.
Oh, it's brutal.
Especially if they live together at any point during the year. This is the infamous $0 to $10,000 trap.
The limits for those who file separately and live together are notoriously punitive. Our source data shows the limit remaining completely static from 2007 all the way through 2021 at just $0 to $10,000.
So what does that mean in practice?
It means if you are covered by a workplace plan, you're married but filing separately, and you earn more than $10,000, your TIRA contribution deduction is completely 100% wiped out. Zero.
That filing status creates a tremendous disincentive for anyone seeking tax deductibility. It really just emphasizes how highly sensitive all these TIRA rules are to your specific filing status.
The implication for you, the listener, is clear. If your income falls within those mid-level ranges where deductibility is being proportionally reduced, you have to pause and evaluate. If you're only going to get a partial deduction, you might be much better off securing the guaranteed tax-free withdrawal later via the Roth IRA, instead of chasing a partial deferral whose benefit is, as we've shown, often tax-neutral anyway.
The power of the traditional IRA, as we said, lies in its optionality, that ability to convert it to a Roth. Let's discuss the logistics of that conversion. What actually happens to the money when you decide to make the switch?
Conversion is the moment you choose to pay the government its share. It's settling the tax debt. When funds move from the TIRA to the Roth IRA, the amount you convert is taxed as ordinary income in the year of the conversion.
It's the deferred principal finally coming due.
That's it.
Which means that converting a large TIRA balance can easily create a huge temporary spike in your taxable income.
Oh, absolutely.
It could push you into the highest marginal tax bracket for that single year. That requires some very careful planning.
It certainly does. You might want to spread a large conversion over several years. But the ability to do this at all wasn't always available to high earners. We need to remember the legislative milestone known as TEPRO.
The Tax Increase Prevention and Reconciliation Act of 2005.
That's the one.
What restrictions did TEPRO remove in 2010 that fundamentally changed the retirement landscape for high earners?
Before 2010, the law was very clear. It prohibited you from doing a Roth conversion if your modified adjusted gross income exceeded $100,000 or if your filing status was married filing separately.
A hard stop.
A hard stop. Tipper removed those specific MGI and filing status restrictions starting in 2010.
This was revolutionary. I mean, it opened the door for everyone, regardless of their income, to get money into a Roth IRA.
It did. This legislative change is the foundation of what's often called the backdoor Roth strategy.
Right, used by high earners who are otherwise excluded from direct Roth contributions because their income is too high. The TIRA became the necessary pathway.
It became the conduit. And there's a key optimization technique for the conversion itself, which involves where you source the funds to pay the tax.
Okay.
There's an extra conversion benefit if you pay the taxes due on the conversion from a separate taxable account, not from the IRA money itself.
Why does paying the tax from an outside account create an extra benefit?
Because you are effectively moving dollars that were otherwise sitting in a taxable investment account, dollars that would generate future taxable gains and dividends. And you're using them to pay for a tax obligation that makes a similar amount of income, now inside the Roth, permanently tax-free.
So you're sheltering more of your overall net worth from future tax.
Exactly. You're increasing the total amount of money that will grow tax-free for the rest of your life. If you pay the tax from the IRA itself, you just reduce the assets that are sheltered from future growth.
That is a very clever optimization technique for people who are managing larger portfolios. Now let's move from conversions to simply moving money between financial institutions.
Okay.
There are two distinct methods for moving IRA-sheltered assets: transfers versus rollovers. They sound the same, but they have critically different rules.
They are drastically different, and you, the listener, must always prioritize one over the other. Let's start with the transfer, which is the preferred method.
What defines a transfer?
A transfer is an institutional move. It's usually initiated by the receiving financial institution. Your new brokerage requests the funds directly from your old one.
And the check isn't made out to me.
Never. The check is made payable to the receiving institution. The money never touches your hands.
And the key administrative factor here?
This transaction is not reported to the IRS. It's seen as a seamless administrative shift that maintains the tax-sheltered status effortlessly. You can do unlimited transfers between traditional IRAs or from an employer plan like a 401k to an IRA.
It's clean and safe.
Very.
Now for the rollover, specifically the 60-day rollover. This is the riskier path.
This happens when the funds are distributed directly to you, the participant. The check is made payable to you personally.
And then the clock starts ticking.
Immediately. The participant then assumes the full legal responsibility to redeposit or contribute those funds to the receiving institution within a hard 60-day window.
60 days is a hard deadline. If I took the check out on December 1st, went on vacation, and forgot to deposit it until February 1st, even if it's only 61 days, have I triggered a catastrophe?
You have triggered a tax catastrophe. After 60 days, the entire amount is treated as a taxable distribution. And unless you are over age 59.5 or meet one of those exceptions, you will also be hit with the 10% early withdrawal penalty.
And there is a major limitation on how often you can do these direct participant rollovers.
Yes. This 60-day rollover can only be done once every 12 months across all of your IRAs combined.
Wow, all of them combined.
All of them. The IRS wants to discourage people from using their IRA as a 60-day interest-free personal loan. If you attempt a second rollover within that 12-month period, the second withdrawal will be treated as fully taxable and penalized.
And unlike a transfer, the rollover is fully reported to the IRS.
It is. The original distribution is reported by the first custodian. Then, once you properly roll the funds into the new IRA, the receiving custodian sends you and the IRS a Form 5498 to report the receipt.
Which effectively nullifies the tax consequence.
If everything goes right, if that 5498 doesn't arrive in time, or if you miss the 60-day window, you face that immediate and very unexpected tax liability.
So the clear takeaway for the listener managing their assets, always opt for a custodian-to-custodian transfer if it's possible.
Always. The 60-day rollover should be a last resort that requires perfect adherence to time and frequency rules. It's just not worth the risk.
We started this deep dive with the historical context of the traditional IRA and that claim that it was the biggest tax break in history.
Right.
And having unpacked the mechanics, I think we can understand why that claim held so much weight. It offers incredible tax-sheltered growth and, more importantly, the invaluable flexibility of the Roth conversion option. It allows you to hedge against future legislative uncertainty.
But that benefit is only realized alongside some very strict rules. The mandatory RMDs at age 72, with that unbelievably severe 50% confiscation penalty for noncompliance.
Unbelievable.
The inherent lack of liquidity for emergencies and the necessary complexity of navigating those income-based deductibility rules. A traditional IRA forces you to become a student of future tax rates.
It really does. So what's the final crucial takeaway for being well-informed about this system? What's the one thing people should remember?
The true takeaway is that the TIRA deduction is less about an immediate, isolated financial benefit, and it's much more about leveraging the difference between your current marginal tax rate while you're working and your eventual tax rate in retirement.
The spread.
That difference, the spread, combined with the universal benefit of permanently tax-free profits inside the account, that's where the value truly lies. You are strategically placing your income at what you hope is the lowest likely tax point in your entire life.
That makes the TIRA a really sophisticated financial bet, and that Roth conversion option is your insurance policy against getting the bet wrong.
Well said.
So since the TIRA's success heavily relies on this assumption that one's retirement tax rate will be lower than one's working tax rate, here's a provocative thought for you to mull over.
Lay it on me.
Considering the enormous and growing national debt and the legislative pressure to fund long-term commitments like Social Security and Medicare, what broader economic and legislative changes could potentially shift those two rates closer together or even flip them decades into the future? If future tax rates are projected to be substantially higher than current rates, does the flexibility to pay taxes now via a Roth conversion become the most valuable financial asset of all?
It makes hedging that future uncertainty absolutely paramount. A truly well-informed saver isn't just calculating today's taxes, they're anticipating the macroeconomic and legislative reality of tomorrow.
Absolutely. That's a wrap on our deep dive into the traditional IRA. We'll see you next time.